Hello and welcome to another episode of Investing with IBD podcast. It's Justin Nielsen, your host, and it's August 30th, 2023. We're taping, for you tomorrow. And so we're going to go over what has been going on with the market. And to help me with that, as he does every week, is Arusha Paris. He's a portfolio manager over at O'Neill Global Advisors. How you doing, Arusha?
I'm doing well, Justin.
Yeah, so we're right here ahead of Labor Day. You got any Labor Day plans?
Well, we have our fantasy football draft.
Yes, we
which
do.
You
I knew the
better
answer to that
show
one.
up this time.
Right, I'll show up this time. So yeah, fantasy football drafts are happening. But before we, even get into the fantasy football, we've got stocks to talk about, and who better to talk about them with than David Ryan, who was a three-time investing champion back in the 80s. He was a protege of William O'Neill. He worked with him, ran the New USA Fund, ran a lot of money for Bill back in the day, and then had his own hedge fund. And now you can see him every week on Tuesdays on IBD Live. Welcome back to the show, David. How you doing?
Doing great. It's always great to talk the market with you guys.
Yeah, absolutely. I feel so lucky because back in November of 1997 is the first time I ever saw David Ryan speak. I was just newly graduated from UCLA, an alma mater that I share with David Ryan. And there he was speaking with Bill O'Neill. It was actually a UCLA USC game. So David had told everyone, I'm taping it at home and no one is allowed to tell me the score. And I was right there with him because I was doing the same thing. I had given up my tickets to the UCLA USC game and was watching David Ryan, Bill O'Neill speak. And that was kind of a life-changing moment for me in stocks and my own investing career. Before we go too far,
USC won. I hope that weekend.
Yeah, we should look that up in 1997.
we
Who
will
won that game? And
UCLA?
Then we should take that helmet down behind you.
Right, exactly.
Replace it with a UCLA helmet.
Yeah. Well, UCLA had a nice run because while I was going there, not to brag, but UCLA never lost against USC. So I'm just gonna throw that out there. And I had a full 5 years there. So, but I also want to throw up this picture real quick. This is back in the day when David Ryan was working at the firm. Here he is surrounded by the chart books, the big, I think those are probably the maroon books over on the left. He's got the daily graphs from the New York and the American, it looks like, on the right-hand side there. And gosh, he's a little baby there.
What happened to your tie, David? You should have worn a tie to the podcast.
I know. Well, that's when they required you to wear ties at work. Maybe they should bring that back for IBD.
Well, but they also had a lot of smoking in the office back then too, didn't they?
Yeah. I was in the front cubicle, and there were, 1, 2, 4 going across, and about 5 going back, and some of those cubicles, all you would see was just smoke rising up from the cubicles. It wasn't good.
Yeah. So, here we are in the current day, and we've got a current market to talk about. One of the things that happened this week on Tuesday was a follow-through day. So we had the index, especially the NASDAQ composite, drifting below the 50-day moving average line. And then, look, a lot of us were getting bearish. Especially after that Thursday when NVIDIA reported its earnings, the market gapped up, got resistance at the 50-day moving average line, turned tail, and it just seemed like, oh, well, how negative can you get? How negative a day can you get? That just was a classic downside reversal. But here we are back above that. What do you think of the action here, David?
Well, yeah, very surprising. I thought it was gonna continue on down, but it held. It got very oversold, so I expected we've had about 3 or 4 days now up. Now it'll be very interesting to see if it can hold or if we go back down. If we go back down below that wouldn't be good. But if you can just drift off for a few days and then continue on, that would be good. The one thing I'm seeing, though, is not as much participation. There are a few groups that are doing well, but will the market come back as strong as it was back in June and July, maybe May, June, and July? So we'll just have to see how it plays out.
So David, you're the volume expert here, and so when I look at the volume down here on the Nasdaq, I know it's lighter volume around here, especially right before Labor Day. Does that bother you here? Does that maybe make take a look at that follow through day a little bit more, be a little bit more suspicious about the signal?
Yeah, you would really like to see volume above average daily volume when you are following through. Um, and yeah, yes, you do have to take into consideration that we are in a holiday, leading up to a holiday, and so the volume is naturally going to be lighter than it usually is. And I've always found in a holiday week like this, there seems to be a bias to the upside. I don't know, maybe everybody who would who wants to sell or has already sold, or they're going to wait until they come back after Labor Day. So there seems to be a bias to the upside in a week like this. So, but yeah, well, I think we'll really see what the market's going to be like when we get back to Tuesday of next week.
Yeah. So now, David, you made a pretty bold call that you think that the Nasdaq has hit its highs for the year. So your expectation was that, we're not going to, we might go back and forth a little bit, but we're not going to have a roaring bull here to end the year. But you're also flexible. I mean, sometimes Twitter demands that you make the definitive statement and not be
Right.
wishy-washy. But then, of course, if you're too definitive, then they're very quick to say, "Oh, you were wrong. How dare you?"
Yeah.
So
Yeah.
does this follow through day change your stance at all?
Well, let's say this is that I have turned around. I covered any shorts that I had,
Hmm.
and I started adding to some of the positions and buying a couple new positions to that. So I'm not like setting my feet in concrete, and I'm not moving.
Right.
If I see the market, I mean, you always have to be flexible.
Hmm.
And I wasn't using the Nasdaq Composite. I was using more of the triple Qs,
Okay.
looking at the seven, I guess they call them 7 or 8 magnificent stocks,
Hmm.
and what they were doing. And a lot of those have had huge moves for the year, had come off. A number of them were below the 50-day moving average. Now a few of them have moved back above that. So they're kind of righting themselves. That I would still be surprised. I mean, we're not that far away, but I would be very surprised if these came on and just had another huge ripping move to the upside after what they've already done.
Hmm. And
Now during
just one
this,
quick, well, before you go there, Arusha, I have to interrupt and just say UCLA did beat USC on November 22nd,
ah,
1997. The score was 31-24. Thank you
was
so much, Allie, for looking that up in the background while we were talking. So
what was
go
Troy
ahead,
Aikman the
Arusha.
quarterback? Was Troy Aikman the quarterback at that point? I want to
No,
say it was
no,
Troy Aikman against
I think
Rodney
it
Peete.
was
Oh no, it was 97.
Cade.
97 this before. Okay,
What was it?
they
Cade
were
McNown at that point? I'll have to look that up too.
okay. Cool.
But go ahead, Arusha.
Well, I don't like that interruption at all, Justin.
Right, exactly.
Yeah.
But
See if we can edit it in post.
exactly. Uh, so, David, now during this pullback or kind of this correction that we just had, how did you handle kind of the individual positions? Were you lightening up a lot, going a lot to cash, or were you holding on to some of the ones that you might have had some bigger gains?
I would lighten up on the ones where I didn't have much of a gain, or if I was even on them, those would be the first ones I would kick out. And then even on ones that I had a big gain, then I would even cut back some of those. And then it helped to be short some stocks
Mhm.
as the market came off. That helped protect. And so. But some of the names I've been with for a long time, I continue to stay with those.
Mhm. Let's talk a little bit because you were pretty big on the TBT trade. Of
Yeah,
course, this is one where if you want to be short bonds and go in the direction of yields, that's something where you can use TBT or there's the triple leverage TMB. But you were pretty bullish on the TBT as you saw rates going up, the 10-year Treasury going up, a lot of these yields increasing. But it seems like one of the things that really helped this market was that we saw the yields come down quite a
yeah.
bit.
Yeah, and
Do
then
you use this macro picture?
oh yeah, I mean, I try to look at as many things as I possibly can to give me a clue to which way the market's going, and when that started moving up and out of that base, I guess it was in the 30s, mid 30s, that yeah, right there. That's where I started buying that position back because it had based out for a long period of time. Now it got close to the highs, but then I think a week ago, it might have been on yeah, last week, it actually gapped down, but held above the 21-day moving average. And so I did cut back some on that position, but I held the rest. But then yesterday, when that JOLTS number on the unemployment came out, then those things really started to break. And so I actually eliminated the rest of the position. Now, today, I guess they were up just fractionally. So we'll see if they can hold in here. But I get I get a great clue of what the market's going to do by looking at what interest rates are going to do, what the dollar is doing, what commodities are doing. So there's a lot of things that go into my stance on the market. It's not just the index. It's a lot of individual stocks, but it's some of these other things. And I think on one IBD live segment, we showed the relationship between the TVTs and growth stocks or the triple Qs, and you'll see that when rates are going up, the Qs are going down, and when rates are coming down, the Qs are moving up. So there's a great correlation between, or at least inverse correlation between the two.
And you're not worried about looking at too many indicators to create maybe too much noise?
No, I mean I mean, there's not that much. I mean, you really should be looking at interest rates because the interest rates are the price of money, and every individual, every business in the country is affected by interest rates and where they're going. So, I think that's an important factor to look at. But yeah, you never want to put all your weight into one indicator. But a lot of mine, yeah, again, comes from can I find enough individual stocks to buy, and can I employ my money? What position can I get in these stocks? So that's where I get a big clue to what's going on.
And maybe you just kind of answered this, but I was going to ask a follow-up to Arusha's question is, when you're looking at a number of different indicators, what do you do when, different indicators are telling you different things, like, or sometimes those relationships break down where you expect an inverse relationship, but then all of a sudden they're going together. What do you kind of do in those situations?
Well, then it all goes back to the individual stocks. Are there enough individual stocks to be fully invested, or if not, at what percentage invested am I? One indicator that a lot of people always seem to bring up, which I found is good, but it's so inexact, is sentiment. When everybody says, "Oh, the sentiment is so bad that the market has got to rally," well, you just don't know where that level is, where the market really is going to start moving higher. And so some of these things are very, very general, and some of them can be a little bit more precise.
Yeah. I always think of the sentiment as kind of telling me what kind of environment I'm in, and then I use the price to kind of do the timing, in the same way that a lot of times fundamentals on an individual stock will tell me, hey, I'm in a stock that a good company, and then the chart is that confirmation piece that tells me, again, what the timing is. That's what I do personally. What about the Russell 2000? Small caps, a lot of times people look at the small cap market and, as a gauge of how much strength we can expect. Certainly the small caps were definitely hit hard by the March, banking crisis that was going on with Silicon Valley and so on. A lot of regional banks in the Russell 2000. This got support at the 200-day moving average line, but doesn't look nearly as strong as the NASDAQ. How does this factor into your analysis?
Well, it's just one more sector of the market, smaller stocks. I mean, I can see that the relative strength rating on it is 59, and it's close to its lows, and it's really been sideways it's really been sideways for most of this year. When I look at the chart, yeah, I guess it came down and made a low last June, and it's just been bouncing between about 200 and 160, 170, back and forth, and basically going sideways. And even in the last couple of days, it's rallied, but again on very light volume, right back into its 50-day moving average. So and there are a lot of financials that make up this index, and you would like to see a little stronger strength in the financials, because that's, if banks are doing well, usually the overall economy is doing well. So, but this is one I rarely, if ever, trade, and it just looks like a big sideways movement at the moment.
So what are some of the sectors that are looking more interesting to you right now?
It's, if you bring up it's G3533, that's
What was
that
it again?
is G3533 is the symbol. It's oil and gas, machinery, and equipment. And this is formed a nice, it had a move up from its lows in May and June, and it's just kind of drifted off for about 2 or 3 weeks, and now it looks like it's starting to go into at least that might be a 9-month high. That's where I found a number of individual stocks doing well. And then there was also G1310, which is U.S. gas and exploration. This has been consolidating for the last over year, has come up, kind of built a kind of a handle, and seems to be doing a little bit better. And that's a lot of this will be influenced by the price of oil. So, but this is one group that held very well as the other parts of the market came off, and seems to have come up fairly nicely in the last few days.
And we'll definitely get to some of the stocks that are in the oil and gas space in our third segment. But we're going to take a quick break. And when we come back, we're going to have David Ryan talk to us a little bit about how to do your position sizing properly. Stay tuned. We'll be right back.
The stock market moves quickly. It can be a lot to keep track of. But what if you had a team of experts feeding you research and trade ideas every morning? Market DM by Investors Business Daily is a daily newsletter that boils down everything you need to know about the stock market into a 5-minute read. You get actionable trade ideas for stocks and options in your inbox every day, plus educational lessons to help you elevate your trading. Subscribe today for only $20 a year. Just go to investors.com/marketdiem, that's market DIEM, to get started.
Welcome back to the Investing with IBD podcast. It's Justin Nielsen here, your host, and Rusha Paris, who joins me every week, is here from O'Neill Global Advisors. He's a portfolio manager over there. And then joining us on the show this week is David Ryan, 3-time U.S. investing champion back in the 80s, portfolio manager with William O'Neill for a number of years, and then also had his own hedge fund and is currently a contributor on IBD Live every week. So, David, let's get into the topic of the week here, and it's position sizing, which can be such a big. It's kind of a personal decision, right? Everyone has their own risk tolerance, but there's certainly some ways to do it and some ways not to do it. What can you share about your kind of overall outlook on how to position size properly?
Well, first of all, as you said, it is personal, and a lot of it depends on where you are in terms of age, where you are in terms of your just your economic standing, or how much you're making, or do you own a home? Are you married? Do you have kids? A lot of that can be influenced by that. And so when I think about when I made my greatest gains, it was when I was single and I had no home, and if I took too much risk, or if I blew up or had some real downturn, that I had another 40 years of income by working in jobs and such. So I could afford to take more risk. But then as the years have gone on, and you have 5 kids and a home and such, then you start thinking a little bit more conservatively, and then I'm not that as nearly as aggressive as I was during that time. But I wanted to bring this sort of two different topics: concentration and margin, borrowing money to buy stocks, of when how this should work. So if you're in a position where you can take more risk, then I would recommend, and Bill even said this in his book, that if you have maybe up to $200,000 in the market or less, you really shouldn't be buying more than 4 or 5 positions. And then maybe if you've got a lot more, go up to 10. But once you start getting beyond 10 positions, then you have to really pick a number of really good stocks to make some huge gains. If you want really, large gains where you can get over a 50% move in your portfolio in a year, or the 100% 3 years in a row that I had back in the 80s, you really have to bring it down to really 4 or 5 positions. And so I would say 4 to 5 positions, 20% in each one max. Um, and then if one of the positions really takes off and you get another chance to add after it's had a really nice move, let's say a stock goes from 25 to 40 and then pulls back to 35 over 4 or 5 weeks and then starts off again, that you can go from a 20% position, which is probably now 25% because you've gotten some appreciation, and add another 10% or even another 15% where it's like 40% of your portfolio. And then it takes off again and you have another run. Well, that's where you can really make some big money, but you have to watch them very, very closely. And when I was talking to my son Sean, who's done well in these U.S. investing championships in the last couple of years, what he's doing is he's really concentrating. I mean, he's not 4 and 5 positions; he's 1 or 2 positions. But he says when he takes a huge position in something, he's focused on it so closely that he's watching it almost all day long. And if something starts not working out, he's quick to sell it back. But yeah, don't be afraid of sizing up on even larger on subsequent basis. And I know I had sometimes 40% of my capital in one stock, but that was in a at a time when most of my stocks were doing well, and I would look to also sell into strength on some of these stocks, and not wait until they started rolling over. So I would actually take some gains on the way up, and then maybe even cut the position way back, hold it longer, wait for another base, and then go back into that same stock in a big way. So,
And so, David, let me interrupt you for 1 second here. So how would you balance that between, I'm going to hold this one going from the 20 to 25% and then pulling back and then eventually building up the 15% to the other one, where I'm going to sell this one into strength, into a smaller position and ride through a base?
well, if I have a stock that's made a really nice move and it looks to be one of the leaders in the market, and everybody is starting to focus on it, I will still, even if I've gotten it up to a 40% position or it's a 25% position, it has this great move, I'll still sell it down when I think it's very extended and bring it back down to a 10% position. But I don't want to leave it. I do not want to lose it out of my portfolio, because once you take it off the screen, lots of times you're looking the other way one day and the thing takes off and goes without you. So, if I find that this is one of the true leaders in the market, I do not want to lose the position. I just want to maybe trade it down a little bit more. So then the question is, when you are focused, you have 4 to 5 positions, when do you use margin? Now, margin should be only used for very brief periods of time. When I hear somebody says, yeah, I'm on margin all the time, I say you're crazy, because you can lose a lot of money when you're on margin when the market sells off, especially if you're in growth stocks, because a normal pullback in a growth stock can be 20 to 25%, and if you're fully margined, that's even a larger percentage. So I say there's weeks or months that you can be on margin and really push it. But when should those times be? Well, I would Justin, you've probably gone over, power trend rallies.
Hmm.
That's a great time when everything is going in the same direction. You've got the 21-day above the 50-day, the 50-day above the 200-day. All three of those are in nice uptrends. That's a time when you can push, you can go onto margin and use some capital that's not yours.
Hmm.
But then also margin can be applied when you've really nailed one or two of the top leaders in the market.
Hmm.
That's when you have the confidence that you pick these things up early and you're starting to get gains in them and the market is taking off. That's when you should have the confidence where you can go ahead and borrow more money and increase those positions appropriately at times when they either pull back or build new bases.
So do rates come into play here? Because I mean, right now, I think people are maybe a little shell shocked if they were using margin a few years ago, and it was like, oh, the margin rates are 5%, and now if they've used margin lately, they're 13%, and higher for the margin rates. Is that a factor for you to maybe not use margin if the
No,
rates are so high?
no, because you're really only using it for a short period of time. You might be
Okay.
on margin for 3 weeks and
Yeah.
then off you go.
Hmm.
Or, maybe if it's a great run and for 2 months you're on margin, boom, you come off. So
Hmm.
in 2 months you divide that, let's say at 12% rates. I mean, you're just paying a few percentage points
Right.
to use that money. So it's not like you're there all year long. It's for very short, brief periods of time when you're in a really nice
Hmm.
move. And I was looking up, O'Neill said that you should use margin in the first 2 years, or you can use margin in the first 2 years of a bull market. But when you start seeing your individual stock starting to stall, or the market starting to stall, then you got to quickly come off of that margin, because
Hmm.
it can be great on the upside, but it can kill you on the downside.
Hmm.
And so during this period of time, during the 80s, that's when I was using margin. I really haven't used margin in years because I have no need for it. So
Hmm.
then, do you want to show those numbers that I
Yeah,
showed?
one more question before we get there. I guess for the concentrated position, one of the biggest, I guess, fears maybe that people have is, what if the four stocks that I choose, I don't get the winner? If I, that's just not enough to increase my chances of picking that NVIDIA. What if I get all the others and I don't get the winner? And so I'm either out of position chasing the leader afterwards, or what happens there?
Well, usually, if you're in a bull market, it's going to last longer than a couple months. It should last for a year and a half. You're going to have other chances along the way to get those ones that took off without you. Some kind of pullback, some kind of base building along the way. That you can then move out of the ones that might not be keeping up with the leaders, and sell those and move that money into the leadership. So if
Hmm.
you don't nail them right at the first move out, you're going to have, and if you look at any stock that has had a great move, they give you, 4 or 5 chances to get into them on another base.
Yeah,
So,
perfect. So where did you want to start with charts?
did you have well, we'll start. I mean, you can start right there, right with Circuit City.
Circuit City. Okay.
This was a stock that I bought all the way back. I mean, this was back in I think 1984.
Hmm.
Um, and you can see this stock actually had already made a move. I mean, it came up from $5 or $6 a share up to 17, and then it put in this long base for a number. Yeah, look at the move that
Oh
thing has
boy.
made. Now, see, that has already had a 3-for-1 split and a 3-for-2 split. This was a turnaround situation. It used to be called Wards all the way going back in the 80s, changed the name to Circuit City, and was the competitor to Best Buy. And so
Hmm.
you can see a beautiful cup and handle that the stock made. and relative strength line going into new high ground, right as the stock was going to new high ground. And the other thing to notice is you see the down in the volume, how the average daily volume was drifting off, coming off. It actually looked like it had dropped in half during that consolidation as the stock was building a base, and that's what you want to see. And then the 3 tight weeks that it had right before it broke out, that's I'm always keying off of that. So, and that's where the well, there you can see the buy right there at right above 16. The first day it looks like it broke out and it finished half range, middle of the range, even the lower range, but then it continued out, pulled back, and then look at the move that it made. I mean, that's a 16 to 29 move, so you get a 50% move out of that stock. I didn't sell it into strength, but it looks like I sold it right when that thing broke the 50-day moving average. So I still got a 16 to 24 move. So that was still a 50% 16 50% move on that stock.
And this is
And
pretty
what
quick.
about
This is not like a 18-month move like for a lot of
No.
leaders. This is very quick. So were you kind of doing these quicker trades and kind of compounding that way for your investing championship?
Because then I would take that and I would move it into another stock, or I'd
Yeah.
have another one at that same time. But when a stock is doing this, that's where you want to hit it hard. And you can really have another buy spot there at 1850, where it pulled back right down to that 50-day moving average, and the volume was lighter. And then look at the volume come into that stock as it started moving back up and out.
Now, I mean, that was a pretty big going from 22 back down to 1850.
Yeah.
1850, right?
That's,
You know,
that's
and a number
20%
of
in
people,
just a few days, right?
yeah, a number of people might get shaken out there. What would you say to that kind of scenario?
Well, I mean, it had one day of volume, and it was still above the 50-day moving average. You know, to have any big winner, you have to give it some room. If you are selling at every, 10% drop in a stock, or even a 15% drop in a stock, you're never going to have a big winner, because they're all going to do that at one point or another, and then it's hard to get back into it.
And is this what was your position size at the time? Do you remember? Were you doing that kind of for?
Yeah, I know.
target
I'm
position
pretty sure
size?
it was at least a 20% position, if not bigger. So I would start my position sizes higher. You have to start higher to do that.
And this is what that looks like on the weekly chart. You want to discuss a little bit about Franklin Resources?
Yeah, Franklin Resources. Here's another one where the stock had gone from 10 to 30, built a base. And this was just one of the companies that were the forefront of mutual funds. And but I said this, I think I said this a number of times. Lots of times I just let the market tell me which are the strongest stocks. I watch to see which stocks can double. I look to see them build a new base, and I get the next double out of them if I hadn't gotten them before. But here's a stock that had a really nice move, and then actually even split, but then put in a nice, that looks like a 5 to 6 week base. And all the volume, look at the volume all along that move. And even when it pulled back for just a couple of weeks in the base that I bought, that the volume was below average weekly volume on that situation.
And
So
I mean, that's
David,
just
when
such a
you were
telltale sign when you see all of that volume come in. When the moving average line, goes up that much on the move up, you know that institutions are getting in there. So yeah, what were you going to say, Arusha?
Yeah, when you were trading in the U.S. Investing Championship, what were the type of position sizes you were taking at that point?
Yeah, it
You
was
remember?
anywhere from 20%, or even for a short period of time, maybe even 40% when a stock was just going through an incredible run. But they were all big. It wasn't a 5% position. It was starting at 10, quickly going to a 20, and then just managing the trade as it got extended, maybe cutting back, waiting for a new base, and then going again. So this is one that yeah, I actually just took the gain after, because look at how many days that was, probably 8 or 9 days that it went from 30 to 40, a 33% move. Went ahead and took that, and I was very fortunate because I think the next day, the Wall Street Journal came out with a herd on the street column.
Oh, geez.
Wow.
Bashing the stock, and you see what
Mhm.
happened. The thing dropped from 40 down to 30, and then I just sat and I waited for it to settle down, volume to dry up, and you can see the average daily volume drops again, and then starts coming on. Look at the average daily volume during that time, 8,000 shares. I mean, that's when, before the market had its big, huge, well, that was part of the start of the big bull market. But anyway, you see the downtrend line and the break of the downtrend, and there it is again, going up on some really nice volume. So back into the stock again. So you can play these things multiple times.
Mhm. And for those folks that are maybe listening to this and are missing out on the charts, remember you can always go to investors.com/podcast to see the charts that David Ryan is talking about. Unfortunately, these are charts that we can't pull up in MarketSmith anymore because these companies, no longer exist sometimes. So that's why we're using these charts from older and other areas. But yeah, it looks like you waited and bought this one again.
Right, and had another great move. Yeah, see, look how so then it goes from 20, and then I guess I added to it again at 30, and now this is split adjusted, I guess, and then it has another move to 50. And when you see something going up at that rate, that usually is a blowout, a climactic run, and I think I waited for the first stalling day to start selling some of the position, and then I sold the rest of the position later as it started breaking down. Sometimes it's hard when you've made so much money on a stock, or it starts becoming like you're a child, and you just can't lose it. You can't get rid of it, and you want to hold on to it. And I guess that's why I stayed in until it actually broke that little base right below 46, I guess.
Uh-huh. So, sometimes it looks like when you were going through your notes, you'll do a little post-analysis. And here's an example of some post-analysis notes that you wrote on a couple
Yeah.
charts that you had.
Yeah, this is all we had back then. Everything was a printed copy, and so so this is where I lost money on Dress Barn. Back, I guess it's 1986, where I thought I was buying a breakout, and it looks like it broke out for a day or two, and then it pulled right back in. And I think what I was doing is that the position sizing, even to this start, was too big. That's why I said way too big under market conditions. So
Mhm.
the market might not be in the greatest of shape. This stock really, I mean, that's when I look at that, I go, what was I thinking? That base just does not, even the move up from 20 to 25, it looks like 3 moves into a top, and then it just quickly rolled over.
Mhm.
The same thing on this New World Pictures. You're only seeing you really didn't see the rest of that base, but I guess I bought it as it was coming out of 22, and once it dropped right back into the base, then I sold the position, but I think I bought that too big right at the beginning. So
Mhm.
but these are things that you should be doing. You should be printing out these charts when you're buying them or when you're selling. Do a post analysis, because boy, that will reveal more. You'll learn more about yourself, your trading habits, and your mistakes than anything that anybody can tell you, because you know why you're making these decisions, and it's best to really study your own actions in the market.
Do you
So,
remember what position size
Mhm.
you were going with starting off with those things?
I don't. I don't know, but I see 5,000 shares at 20. That's 100,000 shares. I mean, if my an 85, I mean that sounds like a 20% position
Mhm.
at that time.
And so, for both of these, you're saying that it was too big under market conditions. So
Yeah.
do you scale back your position size depending on, your feelings on the market
Yeah,
strength?
if the market is, if I'm not if I'm not getting good feedback from maybe other stocks I own or the market in general, or I just can't find that many names, then I shouldn't be starting out as as a 20% position right off the bat. I should start scaling. It should be more 10, then 15, then to 20, but
Mhm.
not that big all at once.
Right. And speaking of kind of getting that big all at once, is this something that when someone's just starting out, should they kind of use this methodology, or is this something that you want to kind of work your way into?
Yeah,
What's kind of the best thing for beginners?
Yeah, that's a good way. If you're just starting out, you shouldn't be doing this you shouldn't be buying in size right off the bat because you're going to make a lot of mistakes in your first 2 years, your up market and down market. And so it's best to I've even said take 90% of your money, put it in T-bills, use the 10% that you've got because you're going to make a lot of mistakes even
Mhm.
on that 10%, and it's better to do it on a small amount of money than all your capital. Once you get the experience, once you start having success, then you start adding more money to the market.
Mhm. Yeah. And you kind of mentioned that, when you were younger, you were a little bit of a gunslinger. Um, Now that you don't need to use margin now. It's not like you're trying to, make the big bucks. You've kind of a lot of times kind of trying to keep what you have. So have you shifted this to more positions, smaller position sizes, or how have you adjusted?
Yeah, more positions. Now the capital I'm working with now, I'm going to 10 positions. But even some of those, when they start working and they're doing well, then that's not going to be a 10% position. With appreciation and buying additional bases, they can get up to 20 or 25% of the portfolio with something that's been working.
Mhm. And we've got one more thing that, as you were doing research, that you came up with that you wanted to share. So go ahead and tell us what we're looking at here.
Yeah, and this, so I had to go back and look at my tax returns for these years when I was winning these U.S. investing championships, and I looked at what I was being paid at O'Neill and the capital gains I was making, and so you can see in '85 my salary was 25,000, but my capital gains were 52,000 in the market, and then the next year. I guess I got a raise. I was making 34,000, but I had capital gains of 255,000. So that was almost 7 times what I was being paid. And then the next year I was up to 58,000 and my capital gains were 449,000, which was almost 8 times or so. But this is where I was using margin, I was using concentration, and you can see the power of the compounding when you can do this, a number of years in a row. It's just amazing how big the numbers can get.
Yeah, and let's not forget 1987. That's when the big crash happened. So it
Right.
looks like you were able to retain a lot of gains if at the end of the year, at the end of the tax year, you still had that sizable capital gain that you were looking
Yeah,
at.
I still remember August of '87. I got married, and during my honeymoon, the market was up. But right as I came back, it looked like the market had topped out. It had one last move in October, but there wasn't anything that was working, and then it just rolled over and died. But I was out long before the crash. The market had topped in August, and it crashed in October.
Hmm. And were these years your U.S. investing championship years too?
Yes,
Yeah.
yeah.
So because I know you had a number of back-to-back years where you won the investing championship, and were you using this position size of roughly 20,
Oh
25%?
yeah, yeah.
Yeah.
This is
Mhm.
where I was really aggressive on the position sizing and also use of margin.
Yeah. Well, that's awesome stuff. Thank you so much for kind of opening a little window into your U.S. investing championship days, what it was like when you were first starting out, and how you got that early success that helped kind of launch your whole entire career. So,
Yeah.
thanks a lot for sharing that. And we'll take a break right now. But when we come back, David Ryan is also going to share some of the stocks that are on his radar right now. Stay tuned. We'll be right back.
The stock market moves quickly. It can be a lot to keep track of. But what if you had a team of experts feeding you research and trade ideas every morning? Market DM by Investors Business Daily is a daily newsletter that boils down everything you need to know about the stock market into a 5-minute read. You get actionable trade ideas for stocks and options in your inbox every day, plus educational lessons to help you elevate your trading. Subscribe today for only $20 a year. Just go to investors.com/marketdiem, that's market DIEM, to get started.
Welcome back to the Investing with IBD podcast. It's Justin Nielsen here, your host, along with Arusha Paris, who joins me every week from O'Neill Global Advisors. He's a portfolio manager over there. And our special guest this week is David Ryan, three-time U.S. Investing Championship winner back in the 80s. And then he was also a portfolio manager for Bill O'Neill at William O'Neill and Company for a number of years, was going on the circuit, speaking to Investors Business Daily and Daily Graphs members back in those days. He was kind of the sidekick to Bill O'Neill. And then, of course, he had his own hedge fund. And now you can see David Ryan every week on IBD Live on Tuesday mornings. So, David, let's talk a little bit about the stocks that have been on your radar. And I just want to point out, you've got a number of oil and gas names here, but you were really pointing out on IBD Live the oil and gas shift. I mean, well, first of all, you were really on top of the commodity shift. I mean, this was back with the fertilizers a couple of years ago when the fertilizers were coming back on very strongly, and then the commodity play that was happening in a lot of 2022, and now just a few weeks ago you were kind of back on oil and gas. What was it that you were seeing in this area that kind of made it a little bit more attractive to you?
Well, I mean, going back to, I guess it was even 2021, where some of those fertilizer stocks, and other kind of cyclical type of stocks, commodity type stocks, were making their move. It was right when, especially later in the year, when a lot of tech stocks and a lot of growth stocks were topping out. The market was shifting, and I've just been through some of these cycles a number of times before, and I just know that sometimes when commodity prices move up, there are companies that really can take advantage of that and make a lot of money. And I've seen it happen a number of times. And so when I started seeing these stocks starting to outperform and their relative strength lines starting to move up and breaking out of bases, that's when I go, hey, I've seen this happen in the 90s or in the 80s, and it can happen again. And even Bill in his book, he really only dedicates, I think, one page to cyclical stocks, but he said 25% of some of the greatest winners are cyclical companies. So they can make some big moves. And there are a lot of people who say, well, I'm just a growth stock player. But, well, there are times where growth won't work and cyclicals will work. But, and that's fine, because you'll get your bigger, longer, more consistent moves out of growth stocks. But so again, this year, crude oil had been coming down for a number of really, actually, it'd been coming down for most of the year. I guess it topped. I'm looking at USO, topped in really all the way back last year, 617 of 2022, and made a low. Really, I guess there was a low earlier in the year in March, and then it kind of consolidated and started moving up in June, and it really broke a downtrend line in June. And so I started looking at some of the names that were actually outperforming or moving up along with that. And the first one was Tidewater. And you can see Tidewater was actually in a nice up move from October of last year all the way up into March. It made it's a 26 to 51, almost doubled in price. And then got hit, and then started going back and forth between 50 and 40. And then when it started coming out, tightened up, and that looks like at the end of June 29th, it is really the buy point, broke out and made a nice move from the 50 up to 67. And then has drifted off for the last couple of weeks, and the volume's lightening up. Today was up was up nicely, and so it looks like it might be just starting to break that downtrend and start another move. But the important thing too, I do a lot, is when I'm interested in a company, I listen to conference calls, I go to their website, I get as much information I can on the stock. And so when that stock gapped down on earnings, you would have to go to the intraday chart on when it opened or was as high as 65, 75, and then was as low as 56. I knew a little bit more about the company. I listened to their conference call, and they said that things were actually going very well. And so so I stayed with the stock. I didn't sell it out there, but that's an advantage of listening to conference calls. When I think I even said this on IBD Live at that moment, the CEO said, "We have never ever seen conditions as good as they are now." Now, why should you sell a stock when a company's saying that, and they just reported a huge number? So that's why I've stayed with it, and I still have the position. And then also in that group is also this is Oceaneering International, which is OII. And here's another one, a little bit lower in the base, but this was also, I started buying it on June 30th as it started coming out of that base at like 1859 into little new high ground. Moved up for a couple of days, pulled right back down onto where it first came out of, and then it took off. And this had a really nice move up to 2380. And okay, so now here it is. It happened again, where the stock reported after the close, and the conference call. What was incredible is this stock closed at 2380 during the conference call, or the stock actually hit $17 a share. It dropped that far in after hours. But listening to the conference call, the CEO said, we have some lumpy quarters, and some of the things that we're going to go into the second quarter have actually been shifted into the third quarter. And so I didn't sell it. I actually bought some more after it opened, and then traded it. It moved up, and now it's moved back and forth, and it looks like it's starting to come on again. But they're saying the same things. The industry is doing very well. Offshore is doing extremely well, and a lot of international offshore has been doing great. So that's why I stayed with this. And you can see more of a turnaround situation, some very big quarters coming through, and you got some good volume today as the stock started moving up, moving higher.
You mentioned you do a lot of research on the companies, and I guess one of the problems sometimes is, some of these industries, like, commodity based ones, it's really hard to know, like, the differentiation, like, oh, this is a midstream company, this is doing, this part of oil. They're all oil related, but it's kind of like, what is the advantage that this company has over others? So I mean, I know, you mentioned conference calls. What other sources do you go to kind of educate yourself, and how expert do you feel like you have to get in the industry before you can make a good decision?
Well, you're using a combination of, I put a heavy weight on price and volume, but then I'm also looking at the fundamentals of the company. I'm looking at the earnings. I'm also I do this every time I look at a stock. I go from the daily to the weekly to the monthly. And so I look at every single time frame of the stock. So if you go to the monthly on Oceaneering International, you can see, look, the stock has made some really nice moves in the past. I mean, that's going all the way back, into the 2000s and 2009 to 2014. That's a really nice move. So I have the history a little bit that these things can really take off when the conditions are right for that specific company and for that industry. So yes, I mean, as much as you can, and I look into some other companies, but I let the market tell me which are the ones that are positioned best, because those are the ones that are going to be the first ones into new high ground, and the ones that are usually going to make the biggest move. So,
Well, and a quick follow-up question, because you mentioned the fundamentals. Sometimes with the cyclical stocks, they don't have the fundamentals, right? The fundamentals are kind of lacking. So what do you kind of use to kind of say, oh, the estimates are looking good, or this is where the turnaround is happening? How do you know? Or is,
Well,
yeah.
you'll usually after 1 or even 2, if you can get 2 quarters of big turn in earnings,
Okay.
then that will give you a clue. You don't have to wait until you get a growth rate after 3 years or anything like that. But this actually started, the move really actually started, at least in terms of the earnings, in September of 22, where their sales were up 20% and the earnings were, I guess, 23 versus a loss, or 23 versus 1. And so it really, when by the time this gets a growth rate, if it lasts for 2 years or 3 years and it has a growth rate and it has all these quarters, that's probably the time to buy them. So you have to think a little bit opposite is
Probably the time to sell them.
yeah, sorry, yeah, it's a time to sell them.
Mm-hmm.
The time to buy them is when the earnings are just starting to turn, and
Mm-hmm.
that's what you should be doing on these cyclical stocks.
Mm-hmm.
So, and then I had
CRS,
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 Carpenter Technology.
Carpenter
Carpenter's,
Technology. Yep.
yeah, and that's this is just a recent buy. So, and you can see this is not as dynamic, or it can move really as fast if you look at the past. I mean, it's kind of a slower, steadier type of company. In 2003 through 2006, it made a really huge move. So I like to see that. And then you can actually see that it's actually, you can draw a downtrend line from 2007 across. It just broke that in the last couple of months. But this is just a recent buy because it's been in a nice uptrend. And just last week, you see, when the market was selling off, this stock got very, very tight. And you can see the relative strength line was holding extremely well, almost looking like it was going into new high ground, even though the stock was consolidating. And then on Monday, that's where I first bought it, and then add to it yesterday, and now it's starting to get a little bit out of there today. But you got 3 really nice days. The last 2 days have been very, very strong earnings.
So you don't consider this a little too extended or anything, right?
Well, now I think it's getting extended. I mean, the buy
Okay.
point 6 is, I guess if you'd say that most of the base has been built under 60, you go
Okay.
5% from that, then I guess you're talking 63. So if you're sort of getting towards the upper range, you want to be buying it as exact as you possibly can. So, so that there's a third one. And then I guess the last one we could talk about is one I've held since, I think, October of last year, and this is Elf Beauty, ELF. And you can see this has just built a number of great bases along the way. And really, I mean, you could go all the way back to June of last year. This stock has only spent a couple of days under the 50-day moving average. And those have turned out to be buy spots on this stock, because it pulls back and then either earnings are announced or the stock just quickly turns and goes up. But you can see, I mean, there's buy spots in the 40s in October and November, in the 50s in January, February. Then you had another buy spot there in March. You had another buy spot. Well, that was more on earnings, so a little bit harder, but that was in May. And then even recently, stock gapped up on earnings again, came all the way back down, got support on the 50-day moving average. And then they made an announcement that they were buying another skincare company. And that's a very small part of their business, but now it's going to be about 18% of their business. So that is going to be additive to earnings, and the street really liked it. So you've gotten a few big days of gains. And I would think here it's going to have to probably spend a few weeks drifting off or going sideways. But it's one that's had a number of bases and continues to perform and do well.
And is this one that it just got on your radar back in October because it doubled once?
Well, yeah, it was, because it had a nice move out of a really nice base. I think it was really August where it really started that move, the first week in August, and then actually kind of based out. But a lot of it, when I was coming home, when I, when we come home from church, we drive about 50 minutes to get to the church we like to go to, and on the way home, I have my wife drive, and I start going through on my iPad. Start going through charts in the car, and I turned to her and I said, "Yeah, have you ever heard of this stock called Elf Beauty?" She goes, "Oh my gosh! I've been telling some of my friends about how I've been buying this," and I said, "What are you doing? You're telling your friends, and you're not telling me that you start buying
Wasn't that
this
something in the
stuff?"
vows?
That's
Yeah.
hilarious.
You got married in '87. I'm sure that was part
Yeah.
of your vows.
So and I said, "Oh, that it's great." But even though I was late by a few weeks on that stock, but look at the move that the thing has made. But you never know where you're going to get your next great idea. But that's what's so much fun about this business, is that it's always this puzzle trying to fit what are you doing? What are your friends talking about? What's the market doing? And trying to find that next great winner. And so this is the way. And even on IBD Live, I remember there was a woman who said she said, "My daughter started using these products. I started using these products," the woman said, and then she said, "and even her mother was using these products." And so you had 3 generations you all using the product. You would have to think that if they were doing it, millions of others or hundreds of thousands of others were doing the same thing. So that was a great endorsement. And I picked that up on IBD Live just by talking about the stock. So
And Arusha, maybe if you show the monthly chart again, just to show how crazy this move has been. I mean, it's just looks straight up. Now, for a lot of people that miss this, there's that kind of urge to like, well, I want to own the winner. I want to say I had some of this, but I mean, this thing is sticking straight up. So, is this just long gone, and if you don't have it, forget about it, or is this still in one of those? Hey, this was so powerful. Wait for another base, longer
yeah.
base, and see if it can come out of it again.
Yeah, I would wait for a longer base. I knew I wouldn't be buying it here, but I would wait for a new base to form, and then go ahead and buy it. But it might have to spend a number of months going sideways after the move that it's made. But at some point, people are going to get used to them, blowing out the earnings, and it won't be as much as a surprise. But so that's why I'm thinking it might have to spend a lot of time going sideways before the next move.
Well, David Ryan, thank you so much for sharing so much with us today. I mean, between the position sizing and also how you got into some of these names and what you're looking at, very insightful and very good stuff for our listeners. So thank you so much for being on the show.
Okay, thanks for having me. It's always fun.
Okay, and that's going to wrap it up for us this week. Joining us next week, Mark Minervini is going to be on the show. Of course, David Ryan was actually speaking with Mark Minervini for some of his workshops that he was doing. So we're going to have Mark Minervini back on the show and kind of get his take on what's happening with the market, what stocks he's looking at, and an important learning lesson from him. Hope you stay tuned for that next week. Thanks for watching.